is a strong dollar story. Fair to say that any pullback will be shallow, given how hawkish the Fed is.
Thanks for having me. Yeah, I mean, at this point, right, I mean, growth is strong, like Kathleen mentioned, and inflation is just not abating at this point, and it's really not about inflation coming down. It's really about inflation going back towards 2%, which will help Fed gain confidence that they can bring it back. But at the moment, they don't have that confidence, so dollars, unfortunately, probably still.
So it's not just about the strong dollar, it's also about the weakness in the yen that is impacting Asian currencies in particular. We've seen how the Philippine peso is at a record low. The weakness in the yen will impact also the likes of the Korean won and the Thai baht.
Yes, so the weakness in the yen, the weakness in the yuan as well, all combined, this region is very highly correlated to CNY, and it'll certainly be weaker as well. And central banks will try to defend, but ultimately at this point, for us, relative value trades, sort of looking at the fundamentals, the domestic fundamental stories are probably the best way to go.
Yeah, Lin Jing, so you look at the relative performances of these currencies. Do they match up with the fundamentals of these countries? I mean, for instance, Thai baht's had a torrid time of it in the last 5 days, but it's been a pretty good month for the baht overall, given what's been happening before. Fundamentals strong, given the second half is going to see a surge in tourism numbers. Then on top of that, we've got Indonesia and the Rupiah. Give us a sense of how you view that.
So for both, I'm actually positive, both the IDR and the Thai baht as well. So Thai baht, to your point, I am expecting tourism to recover. People are still not convinced that the story is there. But if you looked at last month's number, we're already at 1 million tourists for July. You only need 1.1 million tourists for the rest of the year to get to that 10 million tourist mark. And that actually closes the current account back from a deficit into a surplus. And then you've got slightly lower oil prices and also lower shipping costs that will help that current account balance as well. On the Indonesia side, the Bank Indonesia has finally hiked policy rates. I think everyone's waiting for that. So IDR was weak before that, but I expect the fact that they've got a likely fuel price hike coming. They are going to continue hiking gradually and measuredly, nothing too panicky. So a gradual 25 basis point at every meeting, and that should allow the IDR to find some support.
Lin Jing, you're not a fan of the ringgit or the yuan. I mean, the yuan for probably obvious reasons, but give us can you walk through your reasoning behind this?
So I'm not a fan of the yuan given obvious reasons, and plus it's the perfect hedge, really, given the center of calamity at the moment is China. With regards to my not so big preference to the ringgit and also to the Philippines peso, the ringgit, for example, we're approaching election soon, and we've also got palm oil prices, which has fallen quite substantially. So the current account surplus is weakening. I'm not expecting a deficit or anything there, but it is relatively weakening from where it was before, and the Philippines peso is certainly impacted by the infrastructure investment build in Philippines, which will attract more capital imports and certainly weaken the current account there.
You're not quite liking the yuan. We've seen the PBOC fix the currency at the higher end for, I think, 8 days running now. I'm just wondering whether the PBOC can continue to defend the currency. Also, can the yuan, I guess, refrain from getting to 7 before that meeting in October?
I think they will try to keep it below 7 before, but I don't think PBOC is necessarily defending a level. They will keep trying to defend the currency, especially high volatility within it. There are plenty of policy tools they can use, FX RRR, right? Actual spot intervention. So on that front, I do think they will try, but I think, there are too many things going on at the moment. You've got a property sector that is just not recovering. Consumption, for obvious reasons, is also not recovering. So they've only got one driver of growth at the moment, which is infrastructure investments. And that just raises risk of policy missteps, and downside risk to growth.
So risk of capital flight. So far, we have banks aggressively cutting the projection for GDP for China for the year. What are you anticipating? I mean, as low as 2%?
With the current COVID lockdown, possible. I don't have it as low as that yet. I still have a 3 to 3.5% growth target for this, but the recent lockdowns are certainly putting a dent to that forecast. But for us, more importantly, it's the next year forecast that is starting to look very worrying. I don't expect them to open up straight away, and it will be very gradual at some point. But when you put that together, you're looking at a sub 5% growth number again for 2023.